Indian equity markets are going through a prolonged phase of consolidation, with Nifty hovering in the range of 22,000 to 26,000 since the September 2024 highs. However, the past month has been extremely eventful, with a series of policy, macro, and corporate developments that collectively shifted the risk-reward balance constructively. This alignment forms the basis of our theme, Convergence of Catalysts. Globally, the US Fed has maintained a pause on rates at 3.5 to 3.75% while revising US growth projections upward and reinforcing macro stability. Any action on the US Fed rate is likely to happen only once the new Fed chair takes charge in May or June later this year. From India's perspective, the EU-India trade agreement strengthens ties between partners already engaged in over $130 billion of annual goods trade. The India-US interim trade framework moves toward a broadline tariff level of approximately 18%, bringing India broadly in line with other major competing export nations. While actual details of the deal are yet to be finalized, these developments, especially the India-US interim deal, have contributed to stabilization in the INR, back to below 91, and improved external confidence. INR stabilization should lead to reduced need for RBI intervention in the forex market and hence easing liquidity conditions. Further, with a stable INR, RBI can be more accommodative on the rate front if required. The Union budget reinforced policy continuity, prioritizing capital expenditure, fiscal discipline, and structural productivity over short-term populism. With consumption already being supported last year through higher income tax exemptions and GST reductions, the budget marked a shift from welfare-led measures to execution and growth-focused policies. Manufacturing incentives, boost for services, logistics improvement and asset monetization should improve the conditions for sustained profit growth over the long term. Concurrently, earnings are beginning to show early signs of recovery after a period of normalization. Corporate commentary and reported numbers suggest that the profit cycle may be stabilizing and turning, as numbers have been largely in line. The policy tailwinds, global integration, fiscal clarity, currency stability, and improving corporate performance thus represent a convergence of catalysts, supporting a constructive medium-term stance on equities. Most direct beneficiaries of trade gains, manufacturing momentum, and sectoral reforms are majorly concentrated in the mid and small cap space. Further, this segment can provide exposure to companies in the emerging and high-growth subsectors within broad sectors like BFSI, healthcare, and digital. Price corrections and breadth compression in small and mid-cap segments, despite relatively steady headline indices, have improved near-term entry points. From a number perspective, approximately 60% stocks in Nifty 500 are tracking below the 200 DMA. Approximately 45% of the mid-cap 150 stock and approximately 64% of the Nifty small-cap 150 stocks are down more than 20%. Growth prospectus, exposure to emerging companies, good entry points, earnings recovery, and relatively reasonable valuation make a good case for exposure to the segment. The temperature gauge index remains in the fair value zone. Given the current market setup, we maintain a neutral stance on overall equities in the near term, while overweight on mid and small caps. A typical allocation may comprise 50% large caps or hybrid, 10% global equities and 40% mid and small caps. We recommend lump sum deployment only in hybrid strategies, with staggered investment over the next 2 to 3 months into pure equity strategies, including global allocations. In fixed income, while the budget maintains medium-term growth credibility and fiscal discipline, near-term bond market dynamics remain supply-heavy, warranting caution on duration in the near term. RBI has paused rates, kept stance neutral, nudged CPI and GDP projections upward, and doubled down on preemptive liquidity management, but without signaling near-term OMO support. INR has stabilized after the India-US interim trade deal agreement, and that should be positive for the yields. We continue to favor accrual strategies across the credit spectrum through both direct and managed routes, along with income-generating real assets like infrastructure investment trusts for core allocation. For a shorter holding period, 6 to 18 months, one can also allocate in relatively liquid fixed income alternative solutions like arbitrage funds and hybrid SIF funds. Any rise in the 10 or 15-year GSEC yields due to temporary supply pressure in the next 1 to 2 months should be used as a tactical entry opportunity in duration play. gold and silver prices corrected sharply during the end of January or the beginning of February, with silver plunging by approximately 40% and gold by approximately 20% from all-time highs. While ETF inflows are currently supporting prices, the softer central bank buying and easing geopolitical tension reduce the visibility of sustained momentum in gold prices from here. Silver, playing the dual nature of precious metal and industrial use, warrants more caution due to its highly volatile nature. Hence, on gold, we maintain a neutral asset allocation for portfolio stability, continuing to accumulate gradually during market dips while recommending trimming of overweight exposure in silver in portfolios. Overall, precious metals allocation should be more biased towards gold than silver.